Retirement feels far away until one account choice shaves a full decade off the journey. And most people don't even know there's a difference. Today, I'm putting the Roth IRA and 401k head to head. I'll show you and John which one gets you close to a retirement fund of $1 million. I'm going to run real numbers, break down everything you need to know, and simplify it all in a way that actually makes sense. And in the end, I'll show you which of these two accounts will add an extra $90,000 to $100,000 to your retirement fund. All right, first, let's break down a Roth IRA in plain English. Think of it like this. You've got a jar. You fill that jar with money you've already paid taxes on, like money from your paycheck after taxes have been taken out. You'll never owe taxes on the profits when you pull it out in retirement. You put that money into your Roth IRA jar, then you let it sit. And while it's sitting there, it's not just hanging out, it's growing. Because inside that jar, you can invest in things like stocks, index funds, or ETFs. So the money has a chance to grow a lot over time. Now here's the special part. When you retire and take that money out, you don't have to pay any taxes on it. Not on your original money, not on the profits made. Nothing. Uncle Sam doesn't touch a dime of it. There are some rules, though. You can only put in up to $7,000 a year if you're under 50 in 2025, and there's a limit on how much income you can make to be eligible, $161,000 a year if you're single. If you earn more than that, there are still some ways to get money into a Roth, but that's another conversation. Also, you can't touch the earnings, the profit your money makes, without penalties until you're 59 and a half, unless it's for certain exceptions like a first-time home purchase. But, and this is big, you can take out the money you originally contributed anytime, tax and penalty-free. So if you put in $6,000 and need it 5 years from now, you can pull out that $6,000. You just can't touch the extra growth until retirement. One more thing people love about Roth IRAs, there's no rule forcing you to take the money out at a certain age. Most other retirement accounts require you to start withdrawing money by age 73, whether you need it or not. But with a Roth, you can leave it growing for as long as you want. So in short, you pay taxes now, let your money grow, and take it out later totally tax-free. It's simple, powerful, and gives you a lot of flexibility along the way. And that's what makes the Roth IRA such a fan favorite. But before we crown it the champion, let's see what the 401k brings to the table, because it comes with its own set of perks and surprises. Now the 401k. It's like having a retirement account with a built-in booster pack thanks to your employer's matching contributions. Here's how it works. You contribute a portion of your pre-tax income, and in many cases, your employer will match part of it. That's free money going directly into your retirement. Now, the big difference between a 401k and a Roth IRA is when you pay taxes. With a 401k, you're putting in money before it gets taxed. So it actually lowers your taxable income for the year. That might mean a smaller tax bill today, which is great if you want to keep more cash in your pocket right now. But here's the catch. When you retire and start taking that money out, Uncle Sam wants his share. Every dollar you withdraw gets taxed like regular income. So it's sort of a pay later system compared to Roth's pay now approach. As of 2025, you can contribute up to $23,000 a year if you're under 50. That's a lot more than a Roth IRA allows, which is one reason people really like 401ks. You can save a bigger chunk of your income, and with that employer match, the total can grow really fast. 401ks are great if you expect to be in a lower tax bracket later, or if you want to get the biggest possible employer match. That said, there are a few trade-offs. Your investment options are usually limited to what your employer's plan offers. You don't get to pick just anything, like you can with a Roth IRA. And once you turn 73, the government says you have to start taking out a certain amount of money each year, whether you need it or not. These are called required minimum distributions, or RMDs. Still, if you're someone who thinks you'll be in a lower tax bracket when you retire, or if your company offers a solid match, a 401k can be a powerful tool to build wealth. It's like having a financial boost built right into your paycheck. So now that we've covered both options, the Roth IRA and the 401k, the big question is, which one actually gets you to retirement faster? Let's find out by putting them head-to-head with a real example using John. Let's say John works on Wall Street and makes $60,000 a year. He's 30 years old and has decided to put away 10% of his income, that's $6,000 a year, into a retirement account. His goal is to retire comfortably and spend his golden years sipping margaritas on a sunny beach. He's got two choices on the table, a Roth IRA or a 401k, but which one actually works better for him and leaves him more of the retirement balance? Now, John doesn't want to overthink it. He just wants to invest smart. If he chooses the Roth IRA, he'll pay taxes on that $6,000 now. But the money grows tax-free and he won't owe anything when he takes it out later in retirement. With the 401k, he gets a tax break now, meaning he'll pay tax on a $54,000 income instead of the full $60,000, resulting in less tax this year. But everything he takes out later will be taxed as regular income. There's also this little bonus with the 401k. His employer offers a 20% match. Now, to be super clear, most companies don't match 20% of your total salary. What we mean here is 20% of what the employee contributes to the 401k. So not 20% of John's total income. If John contributes $6,000 of his own money, a 20% match would mean the company adds 20% of that amount, $6,000, to his contribution, which comes out to $1,200. In real life, employer matches typically look something like this. We will match 100% of your contributions up to 3% of your salary, or we'll match 50% of your contributions up to 6% of your salary. So if you earn $60,000 and contribute $6,000 to your 401k, depending on the company's policy, you might get a match anywhere from $1,800 to $3,000 or more. But $1,200 is a fair, modest estimate for our comparison today. It's not meant to be a universal rule, just a simple number that helps us compare Roth IRA and 401k side by side in a way that's easy to follow. Now, Roth has a different kind of edge, flexibility. If something unexpected happens, John can pull out the money he originally contributed anytime, no penalty. With a 401k, that's trickier. If John touches the money before age 59 and a half, he could get hit with taxes and penalties unless he meets one of the few exceptions. So while the numbers matter, John also has to think about what kind of life he wants, how much flexibility he needs, and whether it's more important to have a tax break now or freedom later. So what does this mean in the real world? Over 30 years, these little differences add up in surprising ways. Taxes, employer matches, and even the way dividends are reinvested, they all behave differently depending on which account he chooses. But I'm not here to make it complicated. I'm going to keep everything else the same. One single investment portfolio used in both the Roth IRA and 401k so we can clearly see how each account type performs side by side. Now let's take a deeper look at how that investment grows in both accounts. And remember, in the end, I'll show you which one gets you close to a retirement fund of $1 million and which one will add an extra $90,000 to $100,000 to your retirement fund. To really understand how John's money grows in a Roth IRA versus a 401k, we need to zoom in on how each type of account handles investing and reinvestment. First, let's start with the basics. Both accounts allow investments in similar types of assets, stocks, ETFs, and mutual funds. The growth comes from two places: capital appreciation, which is the increase in the value of the investments, and dividends, which is the cash companies pay out to shareholders. John is going to reinvest all of his dividends, meaning he'll use all those payouts to buy more shares and compound his returns. Now let's make this as simple and fair as possible for John. We'll use the exact same investment portfolio in both the Roth IRA and the 401k to make a true side-by-side comparison. That way, the only differences come from how each account type handles taxes, contributions, and employer matching. So here's the portfolio we're going with. It's made up of 3 solid ETFs designed to provide a mix of growth, dividends, and global exposure. There's VTI, Vanguard Total Stock Market Index Fund ETF. This covers the entire U.S. stock market and has a strong history of long-term growth. It's got a dividend yield of around 1.25%, solid dividend growth, and a share appreciation rate of 10.42%. VXUS, Vanguard Total International Stock Index Fund ETF. This one adds international diversification outside the U.S., which helps reduce risk and smooth out returns. It pays a higher dividend yield at 2.88%, but its growth is a bit more modest at 2.81%. SCHD, the Schwab U.S. Dividend Equity ETF. This one focuses on high-quality dividend-paying U.S. companies. Its dividend yield is an impressive 3.96% with a very healthy dividend growth of over 11% and share appreciation near 7.26%. Here's what the portfolio looks like. Now let's find out the portfolio's metrics, and it's fairly simple. To figure out the average dividend yield for John's portfolio, we just look at the 3 ETFs he's using. Each one pays a different amount in dividends. VTI pays about 1.25%, VXUS pays 2.88%, and SCHD pays the most at 3.96%. So what do we do with these numbers? Well, you simply add them together, which gives us 8.09, then divide by 3 because there are 3 ETFs in this portfolio. That gives us an average dividend yield of 2.7%. And that number is basically how much income the whole portfolio pays out each year just from dividends. You can do the exact same thing to figure out the average for other metrics too. For this portfolio, the average dividend growth rate comes out to 7.05%, and the average share price growth is 6.83%. We'll also assume that John sticks with this same portfolio year after year, never pulling anything out early and just letting it grow without interruptions. No trying to time the market, no switching strategies, just steady, automated investing. By keeping the portfolio the same for both the Roth IRA and the 401k, we strip out all the extra noise and focus on what actually makes a difference. This way, we're not just comparing investments, we're comparing the effectiveness of the account types themselves. Now that we've got everything set up, here comes the exciting part, the actual numbers. We're going to see side by side how John's money grows over 30 years in both a Roth IRA and a 401k. The only thing that changes is the type of account. Everything else stays the same. So let's dive into the projections and find out which path brings John closer to his $1 million retirement goal. Starting with the Roth IRA. Let's say John consistently invests $6,000 every year into the portfolio using a Roth IRA and reinvests every single dividend he earns. In the first year, the balance just reflects his contribution, $6,000, but this is just the beginning. In year 10, his portfolio would reach $93,645. At the 20-year mark, his portfolio would have more than tripled, hitting $328,418. And by year 30, John's Roth IRA hits a solid $921,260. That final number breaks down like this. $524,024 comes from capital appreciation and $217,237 from reinvested dividends. Add in his total contributions of $180,000 over those 30 years, and the total value added to his portfolio is $741,260. And because it's a Roth IRA, none of it gets taxed when he withdraws in retirement. That means every dollar of those dividends, every bit of growth, it's all his to keep. Now let's see how John's 401k performs with that little extra boost from his employer. John starts by contributing $6,000 a year into each account, and in the case of the 401k, his employer adds an extra $1,200 annually. That is 20% of his contribution. Every dollar he invests is poured into the exact same portfolio, and every dividend is automatically reinvested. After 1 year, his account would have a value of $7,200. By the 10-year mark, John's 401k is looking pretty strong at $112,374. At year 20, it's grown to around $394,102. And by year 30, it climbs up over $1 million at $1,105,512. That number includes about $628,000 in growth from the value of his investments, plus another $260,000 from reinvested dividends and $36,000 from the employer contribution. And yes, that's the exact same total value added as the Roth IRA, $925,513. That's because the growth is coming from the exact same portfolio with the same habits. The difference? It's how the accounts handle taxes. Unlike the Roth IRA, the 401k is a pay-later plan. John didn't pay taxes when he put the money in, so now when he starts pulling money out in retirement, he owes taxes on every dollar. To keep it simple, let's say John is in a 25% tax bracket when he retires. That means he'll pay around $276,000 in taxes on his funds of $1,105,512. When you factor in the tax-free nature of the Roth IRA versus the taxable 401k, the gap between the two accounts narrows significantly. So here's what we got. Over 30 years, John has put the same amount into both accounts, $6,000 a year. The only difference? His 401k gets a little boost from his employer, $1,200 extra per year, bringing the total contributions there to $216,000 compared to $180,000 for the Roth IRA. Now, thanks to solid investments and compound growth, both accounts grow in a pretty big way. The Roth IRA final balance, $921,260. The 401k final balance before taxes, $1,105,512. So at first glance, it might look like the 401k is the clear winner. More money, right? But not so fast. Remember, the 401k is taxed when John pulls that money out. And if he's in a 25% tax bracket during retirement, he'll owe about $276,378 in taxes. So even though the account technically has over $1 million in it, what he actually gets to keep is about $829,134. Meanwhile, the Roth IRA is completely tax-free. That $921,260, all his. So when we compare what John actually walks away with, here's the final score. Roth IRA after taxes, $921,260. 401k after taxes, $829,134. The Roth IRA takes the crown with almost $92,000 more in John's pocket when it's all said and done. Now, sure, every person's situation is different. Tax brackets can change, and not every employer offers a match. But in John's case, and in many others, paying taxes up front and enjoying tax-free growth for life can be a game changer. Want to know how to supercharge your Roth IRA into $1 million retirement fund with just a $2,000 annual contribution and the 5 best ETFs? Click the video on the screen to find out.